So, Coach, I was thinking about the music for our routine.
Really?
We're gonna skate to one song only.
Hey everyone, hope you're doing well. This is my deep dive into SMCs, which are smart money concepts, which is kind of a derivative of other types of things like ICT or SMC or whichever. And over the last about 5 or 6 years, I would say, I've evolved my trading from, if you look at my YouTube channel, from the ATR, the guppy, that type of stuff is best for long-term stuff or kind of casual, easy trading investment strategies where there's less stress. You just follow the things, you click a couple things, you make some money, you don't lose money, and that's the way those work. The smart money concepts gets you more into the deep dive of things of how the markets are working in the back end, as well as lower time frames, lower than 4 hour, down to all the way to the 1 minute I use these on. And this is what I've been evolving with in the last year to try to gain more strength in my trading and investing strategies, my mindset, to actually try to shift away from a normal 9 to 5 into this type of trading and replace my job. I think that's my goal. If you have that goal or dream, that's great too. But I need to get into the smart money concepts. So that's my little intro. We're going to talk about a list of things: CME gaps, fair value gaps, inverted fair value gaps, BPRs, AMDs, breaker blocks, SMTs, SFPs, and sessions. Those are the main things that I've used and crafted over the last year that I've also learned a lot from other people that use these types of things. So let's get into it. First thing, CME gaps. So if you've seen my other videos, we talked about, I used to talk about, order blocks, breaker blocks, that type of thing. That has evolved now into this, more deep diving into smart money concepts. CME gaps are a big inefficiency in the market, and that's what we're looking for in trading on in the lower time frames, less than an hour, all the way down to 1 minute. And so CME gaps is when you look at the CME, the stock exchange, things happen on weekends, things happen overnight, and that creates a gap from Friday to Monday usually, or some sort of bank holiday or trading holiday usually. And this is like they say a high rate of 90+%. Usually gaps will fill. It doesn't mean that gaps will reverse. It means that price might come back to these gaps as they've left the orders there. Some famous ones on Bitcoin. I'm on a daily chart because the Bitcoin doesn't sleep. It's 24/7, and so things happen after hours that you don't usually get to see on the stock exchange, but you get to see it on the real Bitcoin price. So this is the CME Bitcoin futures. This is where it's easy to see these gaps that I'm talking about. They're little gaps like this, inefficiencies, orders weren't filled, then they come back to it, and you can see it happens pretty much most of the time. This one gapped up, then came back to it, right? And the latest famous one was right around here, around 80K, and you can see that the CME gap here was here for quite some time. So usually you want to go from body to body. You could go wick to wick, go body to body. In this zone, there's going to be some retracement action, and this happened in February. This ripped down, this like that, and then it took a few months to get back to it, and then it gapped back down, right? And so that's where people were kind of looking to short. I know I was looking in this area for some sort of confluence, some sort of break of structure back down, and that type of thing. So that's the CME gaps. Now moving on to fair value gaps. Fair value gaps are basically like CME gaps, but they are just more inefficiencies while the market is open. So a fair value gap would be something similar to this gap. Let's just go to the Bitcoin actual chart on Coinbase so we can see some of these fair value gaps. So just like the CME gap, this is the one that was in the middle here. You can do it from body to body or wick to wick. Usually you want to take some sort of wick before to that one there is usually your fair value gap. It's a 3 candle pattern from a wick of a previous, a full body, and then the top of the wick of the other one, or inverted if it's bullish. These will either usually fill, or those are great places to short. usually as well you want the first presented, it's called. First presented fair value gap could be first presented in a string. It could be the first one that doesn't have anything beside it. And that's where it's very situational, I would say. You know, if let's say this recent dump here, where would be the first fair value gap? Well, some people would say it's, you know, these ones. Some people will say it's these ones. Some people will say it's this one. Usually the closer you are to like a reversal candle, that's not the first presented. That's usually going to be your last presented. And I'll get into some of that later on as well. But that's what a fair value gap is. It's basically similar to a gap, but with actual during trading hours. So now to move on to IFVGs, which are inverted fair value gaps, which is a fair value gap that's been completely disrespected and reversed on. That's what my new strategy that I've been using is IFVGs. I've been learning this over the last 6 months or so on a minute chart, which is a lot of fun. But let's look at a famous one that I called out. If you look up here, this one was a fair value gap up in this range right here. And this one was a fair value gap, and then it got re-inverted, re-fair value gapped over top of it. So as price is going on, we'll just replay this and pretend that this didn't happen yet. This is your fair value gap. So you would label this fair value gap as a fair value gap. You're like, okay, this is bullish. Price shouldn't close back into here. It can retrace, it can bounce around, but it shouldn't have a close. If it has a close, then it's inverted. You drag it over, you look for some retouches if you miss this trade. Then you continue on. Now, this is where I was calling kind of the top of Bitcoin. This is where I started to actually sell all of it, because I wrote it back down from like 20,000 all the way up here. And I was looking for near the end of this year, because, you know, in Bitcoin, the bull markets run for 3 years usually. Then they have 1 year of bear. And so I was looking for some sort of structure at the top here. Now, this, as you can see, got reflipped. We confirmed the flip with this is the fair value gap. This one fully closed, and then the next candle printed and never came back. What I do now is I IFVG this. This usually means a reversal pattern, and usually in an IFVG, if one of these show up, you want to either short or long if you can do that, or you want to sell any spot stuff if it's a bear signal like this is. So this is an IFVG, fair value gap that got disrespected completely. This is the same logic as order blocks. Order blocks turn into breaker blocks when they get fully disrespected like that. That is actually the next thing I want to talk about is breaker blocks, which lined up exactly with this one. So usually you'll have an order block. An order block is again a group of a few candles that line up with something. Let's just take this IFVG out of here for a sec. So this right now is an order block. When price came up to it, it should have some trouble getting through it. When it doesn't, this is in another video of mine. Let's bring this visual order to the front just so I can overlap it. This order block should have some problems getting through it. It didn't. So when that happens, it turns into a breaker block. We're playing Tetris, you know? So breaker block also, which lines up with a fair value gap, which I had before, right? So this is where the nice confluence happens. So as this is forming, you have the fair value gap and a breaker block on top of each other. This is one of my favorite new kind of, I don't know, trading patterns or whichever, is when they overlap, I want to be in on that trade to go beyond it. So if I was buying down here, I would be looking for some sort of fair value gap that gets inverted completely, just like this one, turns into an IFVG, then I would be long on this candle. This candle also has its own breaker block, because the breaker here I'm expecting isn't going to hold, so that's why it's a breaker block. This is the last move up before down. I would be longing into this. If you use the long and short things, if you are a trader, you would probably be in on either this one or this one. Your stop loss would be below, and you'd be targeting at least a 2, right? 2 to 1. You're risking $100 to make $200. This is where I would like to be. This is a secondary kind of thing. like if you're looking to get out a little bit here, and then you want a 2 or a 3, however long you can, right? If you're trading these. But yeah, anyway, this is normal bullish structure. However, this is when it gets inverted. Then it's bearish structure. So I'm overlapping an IFVG. This is the breaker block that got disrespected once, now twice. You overlap both these, we'll just take this out to clean it up. Then this is where I was mentioning to some of my friends and such that this isn't a good signal. This looks like a top of a, chart. And I said I'm going to get out on any next pump because I believe that Bitcoin could be toast here. So I got out of at least like probably 80-90% of my Bitcoin at this kind of bottom, because this is where a normal retouch will happen and then dump. So again, this is an overlap of kind of the knowledge that we have. We have CME gaps, fair value gaps. We get an inverted fair value gap, which is a fair value gap that gets completely disrespected. Then we get the breaker block on top of it, which was from my previous video. When an order block gets disrespected, it gets, in such a nasty way, I'll say, it gets turned into a breaker block. Then we can look at trading these, right? I said the IFVG down here with the breaker above it. This is the same thing, but coming down. This is where any retracement into here you want to sell, and if anything gets beyond this, then you could buy again, because your risk is very tiny. So just to show you how that kind of played out, I sold it about 115, 116 on either the first or second pump because I didn't trust any of this. There's no closes going beyond these two things. So for me, this is all bearish. This is how you should have been looking at it. All bearish, along with the timeline, 3 years of up in Bitcoin. And if you've been around since like a while, you kind of know these cycles, but a lot of people get in the disbelief because they're like, well, this was supposed to be the top or this was supposed to be the top. True, any of these could have been, but your best risk to reward is when these don't close and you need to get the heck out of there, right? So I sold either on 1 or 2 of these pumps. I can't remember. Most of my Bitcoin, most of my crypto, all that stuff, I started, going back to filthy, good old friend Canadian dollar up in Canada here. But anyway, you can see how these IFVGs and these breakers are holding. If you're short, you got to think of the people that do the short positions. The short positions are looking on any retouch and they're looking at somewhere up in here for their stop, and they're looking for like a 2R trade. That's a 2R trade right there. If people are shorting and putting in their stop at the top of there, they're looking for something a little bit deeper. Well, what would be deeper? All these people that have stop losses here that are just going to get ran through, right? So I didn't short this. I don't have a great place here in Canada to short crypto, especially not long term. This is on a daily chart, right? So I don't know of any place. I've tried a few places that either have fees every 4 or 6 hours, which are garbage. There's no great way to do this, from what I know in Canada with any of our investment accounts or anything like that to make the money down. So the best thing for me to do is just sell, the crypto ETFs that I have in some of my TFSAs, that type of thing. Anyway, so get back into smart money concepts. So all of this alone, just some breaker blocks and order IFVGs, these little boxes, these are basics, right? Get into why these happen, right? So there's a thing that people call AMD, not the stock. It means accumulation, manipulation, distribution. So if you were to draw something out, there's not a great paint tool, I'll just use this. You want to have some accumulation, right? You want to have some manipulation to stop out all the people, and then you want to have distribution. That's what an AMD cycle looks like. Then you get some chop, maybe you get double distribution, maybe whatever. Anyway, if you look this out a little bit bigger, let's take out some of these. AMD, usually the A part, you don't really want to be in because it looks like barcode, okay? So just to barcode it up a bit more, this would be a big A, this would be your manipulation down to take out the stops, and this would be your distribution up, right? And you don't usually know, or people use their fib lines or whatever, but this is why things have to go down in order to go up. Things go sideways choppy, they go down, then they nuke up. So that's one way to do it. It happens, that's what bull flags and bear flags are made out of, right? So here's another one. The AMD could be, it's usually sideways, it could be like a little angled, right? Maybe it's like a bull flag, but you get a little bit of manipulation at the bottoms and then you go up. So what do you expect when you're in a bull market? What do you expect it on the way down, right? What if we're in a bear market? The AMD works the other way, right? You look at this. You look at, oh, here's a big box or some sort of flag. There's your, people call this a bear flag if you're a pattern trader. You have your accumulation, you have some manipulation, and then you have a giant distribution. Where do you want to be? On the distribution. You want to see and recognize where the manipulation is and go from there. So that's your AMD. That's the accumulation, manipulation, distribution. Now, the other things that you can also pair all this with, there's still more. Smart money technique, it's called. It's just some sort of phrase that I don't know how the term came to be. They're called SMTs. So SMTs are when two things are correlated and they don't go in the same direction or they don't sweep the same things. So for Bitcoin, its correlated thing is Ethereum. Okay? So when you have, a higher high here, let's just say like that, and then you look on Bitcoin, we'll just open another chart here to show them overlapping so it's a little easier. Let's just go BTC USD. If you line these up so that they sync, you can see my timelines here. Try to line up my timelines right there, like that. So an SMT is when something like this happens. You line up these things, and here, these are going in the same direction. That's normal. But what's not normal is what happens after. They can happen from the same place. This one was higher. And then you look and you grab this one and you're like, lining up with the same, you can see directly the same. It is not higher. It is actually sweeping. So there's a divergence here, and that's what people call an SMT divergence. So something is not going up the same rate or same whatever as the other thing. It looks a little better maybe if you go like that. So you can see this one is sweeping its highs barely. This one is going up. And you're like, well, what the heck is that? It doesn't, like, it kind of matters, but it doesn't really matter. If these show up, it's a bearish sign on both things. Usually, like, the people will say that you'll want to be on one versus the other because it has way more downside risk than the other, which is true, but it kind of gets confusing and you might not be in the trading pair that you're normally in and you don't really know that market, let's say. So this happens with Bitcoin and Ethereum. This happens with NQ and ES, which is your NASDAQ and your S&P 500. It happens on things that are correlated, right? So that's how these work. When these show up, usually you want these, when they show up this bad, let's say, this will be your stop loss. So you label this, you say, okay, well, this is my stop loss. I'm looking for shorts with a stop loss there. So if you were trading Bitcoin in this case, you'd be looking for some sort of short signal and your stop loss to be somewhere around this 82K line. This one, you'd be looking for some sort of short signal after this happens, not before. And that would be your stop loss. That's usually a safe stop loss. They could happen on both sides. This is just a bearish scenario, and I could go back, but they happen on both sides. So a divergence of some sort. So that's SMTs. SFPs, which are another thing, are similar to SMTs, but SFPs happen only on, obviously, one thing. SFPs are swing failure patterns. So they usually mean that a wick has taken out a bunch of stops and wrecked a bunch of people, and now it's going to reverse. And then, so we'll look at that. So this is Bitcoin when it came down. So there's different SFPs. This is a body SFP, and this is a wick SFP. So I trade two SFPs. Some people only trade the one. For me, I trade both. I look for both. And what this means is an SFP is you have some sort of swing point. I use the bodies. You can use the candle wicks. This is just an example of both. You have a body, you have some sort of price going on, and then a wick happens. This is the SFP. This means that these people that were stops, all the stops that were at the bottom of this candle, now are stopped out, and that would give it enough juice to reverse back to the high between the two. How that looks is when this happens on the next candle, it confirms, right? and then it's looking for the high between the two. So you take this and you look for a high between the two, like this one or this one, and then you draw that back down. Looks a little squiggly, not my greatest artwork. Let's try that again. You look for the high between the two. There's one right there, right? You could do this one, you could do this one. But if you're buying down here, you want to sell somewhere up in this range. So here's your signal saying, yep, that was an SFP. We're looking for up. Any retraces, you'll want to look for up. This also had another one saying, hey, I want to go up. Some people buy these, but that's what they call turtle soup in some cases, because when you buy these, how do you know where to put your stop? Then if you can't put your stop, how do you have any sort of risk to reward, right? Any non-trader will not believe in a stop loss, but they'll put a stop, they'll put their, they'll be like, well, I'll just buy the SFP. But then where do you put your stop? What do you anchor your stop to? This guy? Because this could get SFP too, right? You just put it in no man's land? Well, that messes with your risk to reward, as you can see, because I'm looking for to get up to this high. Well, I would like a 2R, but like, I could get wicked here, I could get wicked down here. So then that's why you don't really want to play those, because you don't know where the stop is going to be. You could just be like, well, I'm going to play $100, $100, but then it's like, well, $100 to get you what, right? So that's what a turtle soup is. But anyway, that's what an SFP is. So body SFP is this one, body SFP is this one. They're looking for higher. This is a wick SFP, exact same rules. Exact same rules, meaning like you're looking for the high between the two. There's your high between the two. Technically this one SFP'd and then you doubled SFP'd it, which makes it even stronger. But that's what that is, an SFP. Here's a body one, here's a wick one. Okay, last thing I want to share, let me just get this set up. Okay, so the next thing, last thing for trading in the market and under the 1 hour time frames, you're looking for a thing called sessions, and that's when the market is open for normal trading. There's New York session, London session, and Asia session. I split up New York into 4 separate sessions. So I split up New York, this you can see on the screen here. The hours for New York are technically 8 to 4, right? Eastern time, depends on what time zone you're in. But so I split mine up to pre-market New York, which is basically your 8 or a little bit before to the 9:30. Then you have New York AM, which is your 9:30 to lunch, and then you have your lunch session, and then you have your PM session. And then anytime outside of these sessions are basically no trade zones. Not like no trading for me. They don't line up with any of my patterns or any of my skill set is after hours. That's not me. And then it's very low volume and unpredictable. Then you have London and Asian in different sessions, and they start, technically on the right day, but they might not be in your day. But that's how these kind of look and work. So that's just a little description I pulled off of Google somewhere. My script, the one that I'm working on, highlights the high and low of each session. So while the session is going, let's just say like right here, this is right now the range of New York pre-market session. The reason I use this is because there's news that comes out and that can affect your sessions. So let me just bring up some news just to show you what that looks like. Okay, so this is what the Forex Factory is what I use. This is what the news looks like. So you need to worry about the news for the sessions because they affect the sessions. So we're still talking about the sessions section, but this is the news. So I'm in Canada, so I have Canadian news and US news because I'm in a US market. But there will be things called red folders. Now, red folders are high impact, high volatility news. They could mean that things go up, things go down, they show green and they show red to play with your emotions. They could be good news, they could be bad news. For me, they're just volatility and they're targets. So this is also part of the sessions. So we have the New York stuff. That's what we mostly trade in here. I said I split into 4 sections. We'll look at the chart in a section, we're going to look at the chart in a sec. And these are also to tie into it. So these you can see happen sometimes for me 6:30 in the morning. So obviously I might not be up that early. Some of them happen during the day, and some firms that you may look at dealing with might say you can't trade during these red folder news, and if you do, they blow your account. That's why you have to worry about these. So you have to worry about them for targets as well as for your firm. So let's minimize this. This is the sessions that I was looking at. I have a script that I've been working on. It's called Witcher of Wealth IFVGs. It's not public right now, but for me, it draws out my session high and my session low, as well as VWAP, which is the volume weighted average price, I believe. And then it also draws out previous London low, previous London high, any of those things, and it tells me when those things get swept so that they get taken off of my charts, so I don't have to worry about them for future targets, right? My script also does what we learned before, the SMTs. It also does the SFPs, which is very handy for me. It doesn't get them all. Nothing's perfect, but I try. But this is the sessions part of it. This is more heavy intense. This is probably going to be a couple minutes, but this is what it looks like. So for New York, when it opens, for me, I have the open at 4:30 in the morning. I am not awake, but I want to track where the highest point from 4:30 in the morning until, for my time, 7:30 when the market opens. This is the high, so this scale grows, and we'll see it in the replay here. It marks out the SMTs. I don't have to look on the correlated asset, so this is my NQ chart. It looks at ES, so I don't have to. My script looks at ES, and it tells me there's an SMT here. We're probably going to go down. This is where you want your stop loss to be if you find anything to short of value. The thing to short in this one would basically be your IFVG that we learned in the previous one, right here. Right? This is your fair value gap. If this gets inverted, this is when you say, this is my IFVG. Any retraces or anything that I can do with this, or you could try and front run it. Your stop loss is right above it. So you want to enter as soon as you can if these show up. You're looking for a 2, and your stop loss could be the bear SMT, or if there was a bear SFP, I'd put it here, or just the top of here. You're looking for a 2 or more, right? The idea with the sessions is you're targeting the next line. This is my bread and butter that I'm really trying to focus on and really trying to get, is basically when you see something like this, your target's below, there's nothing in between here. Nothing at all. Your target for this IFVG is VWAP. Or, as this is growing, this pre-market low, it technically isn't here, VWAP is. So that's why you're looking for VWAP. And that's where it hit. So you made 3 times the money that you risked. This has a high win rate. I don't know, I don't have those statistics on me, because it depends which IFVGs you're trading. I'm still working on grading them and figuring that part out, which will be in a different video for IFVGs only. But that's how that works. Let's just see how this day plays out. On the 1 minute chart, mind you, we have bear SFP, means you want to go down. If you see anything, you want that to be your stop loss. You have a bull SFP, meaning you probably want to flip bias. We're bouncing on this VWAP. You probably want to flip to a bull. This would be your stop loss. So anything here, you probably want to watch out for. Another one's forming. They get taken out when they're no longer relevant on my script. That's just something that my script does. But if you're long from here, you're looking for anything going up. You're looking for the pre-market high. So at 7:30 my time, which is around here, the market's going to go open and you're going to see that volatility spike. Boom. You just nailed the pre-market high, which was your target, as you're trying to go up. This bear SFP, bear SMT technically was valid, but I don't usually trade right at open because it's gonna completely wreck you usually right when the market opens, because it's trying to wick both sides of both people trying to play. This is the sessions kind of logic. If you were long in here, you were looking for this and you got it, right? You probably want to go break even whenever you can, wherever you got in, because as you're seeing, there's an SMT, a bear SMT here, as well as a bear SFP showing up here, saying we swept all these up here, as well as ES is showing that it's not going the way that you're going. You probably want to get out if you took this long, or you want to use this as your confluence to short back down. And where do you short back down to? Well, we just opened New York AM, so you don't really want to short back down to that. You could. You probably want to short to VWAP, or you want to short to the pre-market open, the people that got in here that could have stops there that you're going to wreck as well. London low is also a little bit there if you want to have a straggler. This where I shorted on this day, I believe, because I kind of remember this day. So I saw these. I'm looking for the IFVG, or just front run it if you can, to come back. Boom. We just nailed all of this. And if you did risk $100 and turtle souped it with a stop loss in no man's land, this would have worked out. You don't usually want to turtle soup it when you have double confluences, as you know, SMT, breaker blocks, everything that you just learned in this video. Then you can have some confluences that you can be like, yep, this looks really good, I'm fine turtle souping it, or not. Or you wait for your next signal, right? So you just keep going. We do have some, my script marks some 5-minute charts because I'm on a 1-minute as well. But you know that it's looking bearish. We swept all this. If we see any type of SMT down here, from this low to this low, or an SFP down here, then I'd be looking for my stop loss here. Otherwise, you're kind of looking for some sort of continuation, which is kind of like, what's the last signal that happened? What's the last confluence? Well, the SMT and the bear SFP, so technically those are still valid stop placements. You could theoretically just short another one somewhere in this zone, right? So put it at the SFP, the SMT somewhere up here is your stop. You'd be looking for, well, looks like Asia's down there, and we got a 2 risk to reward. That looks really good. And then you just say, well, I'm going to take this. You also start looking, well, where's an IFVG? Well, kind of right here, actually. There was one, so maybe we missed that one, you know, if we didn't front run it. But anywhere in here, and you're looking for another continuation, because a 5-minute, if I were to switch time frames, is right here. Do it again. Do it again, and boom, right there. We swept Asia low. Asia low now stops, you know, going forward. So does all these other ones. We leave this high up here for maybe another day, right? So that's how the sessions work. This is how, you know, transitioning from a pre-market to AM, that's how the trades work. Could have taken 2 trades, you know, in half an hour's time or whichever. The first, you could have done this one. You could have done the bull going up, done this one, and then done it again, have 3 winning trades, make, you know, 10 times your money that you risked, let's say. And there you could have, you know, on an account that could have been like $1,000 and you risked $300, right? Like, it could have been anything. But anyway, that's how the sessions work. This continues. My script that I'm working on continues to draw these sessions as they keep going until they get wiped out, and then they just say swept after, right? So, and VWAP is kind of another target that just kind of like moves and goes with you, because it's not a solid line all the time. It's where price likes to come back to. So you swept something, then you reverse. That's usually how it goes. We swept this top one. We had really good confluences for bear SFP, bear SMT, really good confluences. We swept here. We didn't do any of the bear SMT SFPs here. So keep going, right? This one, we swept it. Now we're looking back up. We still don't have any, you know, type of SMT SFPs down here. You'd be looking for some sort of IFVG if you can. And that's basically right here. But it's not a high grade quality, right? So anyway, that's what I want to share on this one. More smart money concepts, things to learn. There's a lot of people that trade these types of things. I want to make more videos with the IFVG specifically. That's the way that my script trades. As well as structures of IFVGs. Because if one happens, like if you're trying to trade an IFVG way at the end, like let's say here, and it goes up, that is not a high quality one at all. Like you're way too late. You're like 3 hours late, right? So things like that. But just to give the deep dive into more smart money concepts, evolving from the order blocks that I posted 4 or 6 years ago. I don't know how long it's been, but I know it's a long video. Hope you guys are doing well. Thanks, and talk soon.